Hey, Primerica, let's take some time and talk about a product known as an equity. Now, when we talk about equity, we're talking about pretty much anything that has to do with a common stock or a preferred stock being in it. So this could be anything from obviously common stock to preferred stock. It could be an American depository receipt, which is a receipt of a stock. It could be an option known as an equity option, where the option, the put or the call, is based on a common stock. So, when we talk about equities, there's actually lots of different things and some corporate actions that we have to know about them as well. And then, of course, we'll move on and talk about debt in the later units. But what I want to start out doing is just talking about the difference between them. Sometimes we kind of don't get this information till later in the book, or sometimes it's stuff we forgot depending on what test we're studying for. So I just want to take a few minutes and say, equity products, you have to own something to be able to sell it. So a company, like let's say I own a laptop company, if I own it, then I certainly could say, hey, I'd like to sell it in pieces off to other people, like investors, like I could do in an IPO by selling shares of stock. So, and then of course, once you buy those shares, you own them, and then you're allowed to sell them or give them away or whatever you may wish to do with them. So, an equity security means ownership. Equity ownership, that is synonymous. So, it's very important. So, as a company, if I'm going to do that, the reason I would do it is to raise money, right? I'm looking to have more people put money in the pot so that I can operate off of it. I can raise capital by doing so. Okay. A debt product, much different. In a debt product, as an investor, you're loaning money to a company or to an issuer, I should say. So if you loan money to them, then later on they're going to pay you back. But while you're waiting for them to pay you back, they're going to pay you interest. So it's just like how if I borrow money from a bank, I have to pay interest ultimately until it's paid back. So it's the same type of concept. But in one case, I'm buying something that I now own. In the other case, I'm loaning money to an issuer. So two different types of products, and really no matter what securities product we look at out there or learn about, in one way it's either an equity or it's a debt. So those are the two main ways that securities are sold. Now, when we talk about how they're sold, we have to take into consideration that there's three types of issuers. There's corporations, like I just talked about, and then there's municipalities, which are state and local government, as well as the federal government. So we know that municipalities and the government, they're not owned, like they don't own themselves, I guess I should say. A municipality is supported by its taxpayers, but it could never sell pieces of itself off like its common stock to raise money. However, of course, they can borrow money. And the federal government the same way. We know the federal government is supported by the US citizens' tax dollars, right? So we own the government, we own the municipalities. And so since there is not just, one owner or a few owners, then it's not something where they would be able to make a decision to be able to sell parts of itself. So when we look at those two products side by side, we can see that corporations as an issuer could sell both debt and equities, whereas the municipalities can only sell debt securities. And of course, we'll talk about those different debt securities when we get into those units. Okay. Next, we have three types of investors: institutional, retail, and accredited. Let's start with institutional. Institutional investors are typically going to be an entity for test purposes, entities with 100 million or more, like insurance companies and banks, mutual funds, pension plans, things like that. So those entities would be treated as institutional investors for communication purposes. And certainly anyone that oversees the bank, like the bank's CEO or the investment advisor for the mutual fund, they would be treated as institutional investors as well, even though they're a natural person. Now, all institutional investors are automatically considered to be qualified as accredited investors, and we'll get into talking about them in just a minute. But let's get to retail investors first. Your retail investors are your average investor. They're not sophisticated, they're not savvy, they're not considered accredited. Therefore, they require full disclosure. And full disclosure basically means that we need to explain and provide all the information we possibly can, explaining the risks that they're encountering by purchasing the product that they're choosing, of course, with our help in most cases. Then we have our accredited investors. The accredited investors, as I said, institutional investors are automatically accredited. And then anyone like a director or an officer of an issuer, they would automatically be considered accredited. And then, of course, there's certain licenses in the securities industry, like the Series 65, for example, which make you automatically accredited. And then there's you and I being able to qualify to be an accredited investor. That's done with either income or net worth. It doesn't have to be both. So if it's income and I file as a single filer on my taxes, then I would have had to have made $200,000 for the last 2 years and intend to make that this year. So in other words, I would have had to have made $200,000 in 2024, $200,000 in 2025, and intend to make that in 2026. That would allow me to be accredited. If I filed my taxes jointly with another, same rules, but that number goes up to 300,000. Or I could qualify based on my income, or my net worth. My net worth, what it would do is anything $1 million or more in assets would qualify me to be accredited, but I can never include my primary residence in that number. So whatever my primary residence is worth cannot be included in the net worth to qualify me as accredited. Now, you notice I use some other words when I'm talking about accredited, and we call these synonymous terms. So sometimes they'll call the accredited investor a qualified investor. Sometimes they'll call them the savvy investor. Sometimes they call them the sophisticated investor. And in any and all of those examples, that would all be the accredited investor. So accredited, qualified, sophisticated, savvy can and will be used interchangeably on your exams. Now let's cover some terminology before we get into talking about common stock. Here we're going to talk about a company. We have EBI, and EBI is looking to go ahead and do a IPO. And they've decided that they want to offer 2 million shares for $22 a share. That's going to raise the capital that they think that they need for this offering. Now, when we're taking a look at how these shares are described to us on the exam, we need to understand the difference between authorized versus issued versus outstanding, and then, of course, unissued. So let's first talk about authorized. Authorized shares are written in the corporate charter, and the only way that this number can be changed is with the majority vote of outstanding shareholders. The likeliness that a shareholder would want to vote that we issue more shares is unlikely. So we never want to leave that in the hands of the shareholders. So when we write our corporate charter, we're going to write a very large number for authorized. A number so large, we'll probably never issue all of them. In this case, although we have 100 million authorized in our corporate charter, as we stated, we want to offer 2 million. So, assuming we're not exempt from registration according to the Securities Act of 1933, we're going to register these shares with the SEC, and they will set an effective date, which will allow us to issue the shares out to the public. Once those shares have been purchased and they're in the hands of shareholders, they're referred to as an outstanding share. Typically, issued shares and outstanding shares will be the same number, although we will cover a situation that could be different. Therefore, what is authorized but hasn't been issued would be 98 million. So let's take a look at that situation where issued and outstanding wouldn't be the same. And in that case, it would be what we call treasury stock. You see, a company may decide that they want to buy those shares back from the public. They call them stock buybacks, tender offers. There's different ways this can be done. When they purchase their own shares back from the public, this is known as treasury stock. Treasury stock is a stale type of security. There is no value to it, no rights, no privileges, nothing. It sits totally stale. It doesn't even go towards the overall capital of the company while it's in treasury. And companies do this for various different reasons. They might buy treasury stock in order to pay bonuses out to employees, or they might choose to use them to issue stock dividends, or they may choose to retire them completely and never put them out for sale again. So let's assume that EBI obtains some treasury stock for $500,000. Then we know that if it's in EBI's hands, it's not in the hands of a shareholder. Therefore, we would have to subtract the treasury stock from the issued shares in order to discover the outstanding shares, the shares that are in the hands of shareholders, which would be 1.5 million. And of course, the authorized but unissued would remain the same. Now, before we move on, let's just cover shelf offering and green shoe option real quick, just to make sure we have an understanding of them in case there's mention made. A shelf offering is when a company is going to do an offering, but they choose not to put them all out there for sale at the same time. So they're going to leave some in the pantry. Let's say instead of treasury stock, we'll say this is the shelf offering. There's 500,000 being held back. Those 500,000 shares must be issued within 24 months. If they're not issued within 24 months, then they go back into the authorized shares and at a later date would have to be registered again with the SEC. If they are a well-known seasoned issuer, and sometimes on the test you'll see that abbreviated to WKSI. If they're a well-known seasoned issuer, then they have 36 months to put those up for sale before they have to go back to authorized. The green shoe option says that if the shares were to sell in a short amount of time, not testable, then you are allowed to issue an additional 15% out to the public for sale without having to go back through registration. The green shoe option, 15% in addition to the registered offering. Okay, so if you run into those, you'll know what they are. If you don't, no harm, no foul. Now, when we're issuing securities, we look at this type of stuff: large cap, mid cap, small cap. And we have to have some understanding of what they're talking about here. What makes it a growth stock? What type of growth is it? Is it income producing? And of course, in a foreign stock, is it developed or emerging? So let's talk about those. When we look at large cap stocks, this is any company that has assets of 10 billion or greater. These are also sometimes called blue chips. And when we're looking at these large cap stocks, these blue chips, then we look at this as a very conservative place to put our money. It's unlikely they're going to lose money in big amounts overnight, nor is it likely that they would, go booming and explode as far as a bigger company overnight. So it's very conservative to place money there. And because they've been around so long and they're such a large company, then most likely they're showing more profits. Therefore, it's more likely the board of directors will declare dividends to be paid out, which is the income that could be produced through owning stock. So large cap stocks, also known as blue chips, are generally income producing and they are very conservative. Mid-cap stocks are worth anywhere from $2 billion on up to $10 billion. Mid-cap stocks are considered to be a moderate growth. They're kind of slow and steady. And likeliness of a dividend is slim, although there are mid-cap stocks that are income-producing stocks, but not as likely as you'd see from a large cap. Small cap stocks, 300 million on up to $2 billion. These are a very aggressive type of growth. Because they're small companies, they're more likely to go out of business. So there's more risk involved in buying a small cap stock. And the idea of an income being produced from these is really unlikely. The income for a small cap, any time these companies are profiting, they're putting it back into the company to continue to grow. So small cap stocks do not produce an income, and they are a very aggressive growth style. Now, I said they're risky, but keep this in mind. With greater risk comes greater potential reward. Then, of course, whether it's large cap, mid cap, small cap, is it a US stock or is it a foreign stock? And when we look at foreign stocks, we have to look at, is it in a developed nation or is it in an emerging nation? We call these developed markets and emerging markets. Developed markets would be like Europe and Asia, where the markets are developed and have the same types of regulations as the US market centers do. Emerging markets like South America and Africa do not have those same type of markets. In fact, because of their economic instability due to politics and things like that, they tend to be quite unstable and so therefore would produce more risk. However, as I stated, more risk creates more potential gain as well. And of course, we have penny stocks. And guys, penny stocks, it's pretty simple. If a listed security falls below $5 a share, then it's no longer allowed to trade on the exchange. It has to be an unlisted security and trade over the counter. Because of the devaluation of this stock, penny stock can be very risky. So the suitability rules are very strict. The cold calling rules, determining suitability, these are a must. Unless the customer is established as a penny stock trader. And to establish yourself as a penny stock trader, you can do so by either purchasing penny stock and holding it for greater than 12 months, or you could purchase 3 different penny stocks on 3 different calendar dates, and this would automatically establish you. An established customer is not required to go through the suitability standards that someone who is not established would be for penny stock. All right, so like I said, that kind of stuff just kind of lays out a foundation for us. It puts a backbone behind everything and gets us ready to talk about common preferred stock. So common stock, what are the things I look for when I'm purchasing a security? Do I want ownership? Well, then I want common stock. Do I want that income potential to receive those dividends? And of course, the board of directors is going to meet every quarter. So that's how often they would declare dividends. Dividends are paid every 3 months, quarterly, if they're declared. But they're never guaranteed. It's important to know. Capital appreciation. I love the idea that if I buy stock at $20 a share, it could one day be worth hundreds or thousands of dollars. The fact that I can transfer my ownership, I can either sell it to someone else or I can give it to someone else. That's up to me. And of course, the idea that I have ownership in this company, but my liability is very limited. If this company were to make an error and need an attorney, or if they were to make, bad business decision and have to go into some sort of bankruptcy, I don't need an attorney. That doesn't show up on my credit. My liability is limited to the amount of money I use to invest in that company. So if I use $10,000 to buy their shares, all I ever stand to lose is $10,000. Now, we have various different rights when it comes to owning common stock. The first right is what we call the voting right. And the voting right allows us to vote on corporate decisions that are big, not day-to-day stuff. Like we would never vote on who they hire or who they fire, regardless to who it is. So hiring and firing are not part of our responsibility through voting as a shareholder. We vote for major corporate decisions, like who's on the board of directors? Will there be any changes to the corporate charter? Are they going to change the name of the company? Those are all things that we would get to vote on. What we want to do when we're looking at voting is look at whether it's statutory voting, also sometimes referred to as regular voting or non-cumulative, or is it cumulative voting? In either case, the formula to find out how many votes we have the ability to cast will remain the same. You always take the number of shares that the investor owns and multiply it by the number of seats that are open to be voted for. So here we would take 100 shares times those 3 seats. That's 300 votes that I have the ability to cast. And in statutory voting, I would have to equally distribute those votes amongst those chairs. This style of voting is going to favor the big investors, people with a lot of shares. Cumulative voting, same formula. I have 100 shares, but in this example, there's 4 open seats on the board. 100 times 4 gives me the ability to cast 400 votes. However, my votes can be split up however I choose to. I can put all 400 votes on one seat if I wanted to. This type of voting will favor the small investor, someone with less shares. Some other rights that I have as a common stockholder, the first one would be being able to freely transfer my rights. My shares that I own, I can give to anybody or anything. I could put them up as collateral. I could give them away. I could will them to someone upon death. Let's talk specifically about gifting and inheritance, okay? So gifting and inheritance, when we look at the difference, the main thing is who's taxed and when, okay? So let's talk about a gift first. Let's assume that I own these shares and I'm going to gift them to you. This means I'm still alive. I'm giving them to you as a gift. Let's say I bought these shares at $20 a share and they're now worth $50 a share. When I give them to you, my original cost basis will transfer to you. So now those shares that you hold have $30 in gains. And if you were to sell them, you'd be taxed accordingly. Whereas an inheritance, let's say that I own those shares and I've died and I've left them to you as an inheritance. Same example, let's say that I bought them at $20 a share, but on the date of my death, they were worth $50 when you inherited them. The cost basis is now switched to equal whatever the value was on the date of my death. So you get those shares with a cost basis of $50 a share. Anything above that, you'll be responsible for taxes on. Anything below that, my estate had to pay the difference in taxes. Another right that I have is the right to access the books and records of the company. Although it is a limited access, I get to look at things like the balance sheet, the financial statement, the meeting minutes when the board of directors meets, but I don't get to look at everything that goes on. Imagine if I was able to, there'd be no such thing as insider trading. So it's a limited access to the books and records. The last right that I have is known as a preemptive right. This allows me to maintain my proportional ownership in the event that there were to be more shares offered. So let's say that during the IPO, I bought 10% of the company's stock. I'm a 10% owner in EBI. Well, let's say 5 years later, EBI decides to issue another 1 million shares out to the public. They're raising money for another reason. When they issue those shares, that would dilute me. I'd no longer be a 10% owner. But my preemptive right gives me a short-term opportunity, 30 to 45 days or 4 to 6 weeks. That means the same thing. For me to be able to make a purchase of the proportion of shares that I already own in the company. So I'd be allowed to buy 10% of this additional public offering in order to maintain my overall 10% in the company. I can exercise that right. I could sell my preemptive rights to another person, or I could allow them to expire, but that would be silly because they have value. So obviously, we understand the benefits of owning common stock. What are some of the risks? Well, the benefit of capital appreciation sounds lovely, but what if the company fails? The idea that I could get those dividends is a wonderful thing, but we have to remember that dividends aren't guaranteed. The income potential is there, but it's not guaranteed to me. And as a common stockholder, I'm last in line for everything. If this company were to go through bankruptcy, I'm an owner. I'm standing there with my hands out like, am I going to get any of my money back? And there's a good chance I won't after they've paid all the bills. We call that having a residual value. Now, also, we should state that if a dividend is declared and there are preferred stockholders, the preferred stockholders get the dividend before the common stockholders do. Often they'll call common stock the junior security for those reasons. Preferred stock has no voting rights. The other rights exist, but not voting rights. They have priority when it comes to liquidation. If they're going through bankruptcy, you know how the common stockholders last? Well, the preferred stockholders second to last. When dividends are paid by the board of directors, they will pay based on a percentage. It's a stated amount. So let's say that I own a 5% preferred. That will be based on 100, unless they tell me otherwise. You see, par is an arbitrary number. So if it's 5% of 100, then that's $5. That's an annual stated amount. And if I'm getting my dividends quarterly, that would be $1.25 per quarter. But if they were to say, for example, par is 80 and I own a 5% preferred, then 5% of 80 is $4. Therefore, I would only get $1 per quarter. So you got to watch that. If there's no mention of it, assume it to be 100 for preferred stock. If they make mention of it being different, you have to figure the stated rate based on that. Now, because we are told what we're going to get when a dividend is declared, then the investor that's seeking an income is who this is most suitable for. So we take someone who wants equity and they're looking for an income. Preferred stock is the recommendation that you would make. Now, when I look at preferred stock, I look at, is it straight or is it cumulative? Straight preferred, also known as non-cumulative, has no benefits beyond what I just stated. Cumulative preferred has an added benefit. It says that if a board of directors fails to pay a dividend, then they have to write an IOU that they have to make up before they pay a dividend in the future. So let's assume that I'm a straight preferred and I was supposed to get $1 every quarter and no dividends were paid at all in 2025. They don't owe me anything. It's a risk I took when I bought stock. But if I owned cumulative preferred in the same example, they would owe me $4 for the year, $1 for each quarter they never paid me. And so in 2026, if they want to pay a dividend out, they'd have to pay me my $4 before they could pay anyone else. We call them arrearages. Cumulative preferred allows arrears to grow, which must be satisfied prior to any dividend distributions. Now, once we determine is it a straight preferred or is it cumulative, then we look to see if there's any added features, like is it convertible, which means that at any time I can take the value of my preferred stock and convert it into that same issuer's common stock. Is it participating? Participating preferred allows the board of directors to make a decision to give additional funds to the preferred shareholder if they choose to. Is it callable? A callable preferred means that at any time the company is allowed to buy your stock back from you at whatever today's market value is, and you have to let them. And is it adjustable? An adjustable rate preferred is usually going to follow like treasuries, like T-bills or something like that. But it could track a particular index like the S&P 500, which of course could allow you to possibly receive additional money beyond the stated amount. So we understand the benefits of owning preferred stock, right? The fixed income, the limited liability, and the preference over the common stockholder. The risks are that we don't get to vote. And of course, although we are preferred over the common stockholder, we're still very low on that order when it comes to liquidation. We're second to last. Now, I had mentioned earlier something called an American Depository Receipt, an ADR. So let me explain an ADR very quickly, not a lot to understand here. Let's say that I want to buy stock in Japan. All right. I'm allowed to do that, of course, but I have some hurdles to jump. What time is it in Japan? How does my US dollar convert to the yen? Can I speak to anybody in Japanese? Do I know the language? All of that's going to be important for me to be able to obviously be knowledgeable in that market. So if I'm incapable of jumping those hurdles, what I would do instead is look for a US bank that has acquired the stock that I'm interested in. And then that US bank will issue a receipt that represents that stock. Usually it's one receipt for every share, but sometimes they'll cluster them, like one receipt represents 50 shares or 100 shares. Now, when I have that, I get to enjoy the benefits of owning the stock as far as if there's a capital gain and I sell it, I get to get that money, taxed, of course. If there's dividends, I get that money. Of course, it would have to convert. It still has the currency exchange risk. But I don't have any of the rights typically. Understand the bank owns the stock, so they get the voting rights, they get the preemptive rights, and anything else that would come along. So it's an equity product in the fact that it's still stock, but I don't own the actual stock. Instead, I own a receipt that represents the shares. Now, we're going to talk about a few things to finish up here. First, we're going to talk about Rule 144 and how to discover it. Then we're going to talk about dividends, how they're paid out. And then we're going to talk about stock splits. Okay? So let's do Rule 144 first. And Rule 144 requires us to understand the difference between a restricted stock and a controlled stock. So let me go ahead and lay out the restricted stock first here. And we're going to just kind of pretend like controlled's not even on here yet. Okay? So a restricted security will always be unregistered, which means it's exempt. According to the Securities Act of 1933, for one reason or another, most likely how it is issued, it will not have to register. You'll learn those when you get into, learning about what is exempt. Things like Regulation A, Tier 1, Tier 2, Rule 147, and private placement. Now, these restricted securities could be purchased by affiliated people or non-affiliated people. Don't confuse affiliated with insiders. Insiders are all affiliated, but you could be affiliated and not be an insider. For example, you could be an employee of the company. You could be an attorney or a accountant that worked in the last 24 months on the behalf of the corporation. You're still considered affiliated, although at that time you're not receiving inside information. Okay? So non-affiliated people, nothing to do with the company. Affiliated people, something to do with the company. Now, regardless to who owns this, whether they be non-affiliated or affiliated, they have to hold the securities for 6 months from the time they purchase it. That is a requirement. The non-affiliated person, after the 6 months has been satisfied, can sell their securities however many they want to whoever, wherever they want. Whereas the affiliated, they're required to follow the volume limits that are set forth in Rule 144. And we're going to cover that in just a moment. Then we have what we call controlled securities. And controlled securities are always going to be registered, and they're only held by affiliated people. There is no holding period for a controlled stock. However, when this affiliated person would like to sell their securities, they are required to follow the volume limits that are laid out in Rule 144. So, now that we understand the difference between restricted and controlled stock, let's talk about Rule 144. Assuming the affiliated person wants to sell their shares, they would have to file a form known as Form 144, and this would be good for 90 days. In that 90 days, they're allowed to sell the greater of 2 thresholds. The first threshold is based on the outstanding shares. 1% of the outstanding shares of the company would equal threshold number 1. Threshold number 2 is the average number of shares that have been sold in the most recent 4 weeks. So let's take a look at an example here. This example gives us 6 weeks, and since we know we only need the most recent 4, we could get rid of those 5th and 6th week. We would then take the 4 weeks that are important, add them together, and divide them by 4, and that would give us threshold number 2. As I stated, we're allowed to sell the greater of the 2 of these, which of course is threshold number 2. Here we have an example of how you may see it in a question. Lori Davidson owns 8% of Copper Mountain Metals Corporation, and her spouse Ron owns 4%, and Ron would like to sell some of his shares. When he files Form 144, he discovers Copper Mountain has 2.4 million outstanding shares, and the recent trading volume is as follows. Now, we look at threshold number 1. 1% of the outstanding shares, that's 24,000. So that's threshold number 1. Threshold number 2, we have to take the average of the most previous 4 weeks. Here in this example, they've given us 5 weeks. So we'd have to get rid of the oldest week. We'd then add these 4 together and divide them by 4. This would give us 24,500 shares. And as we know, we're allowed to sell the greater of those 2 thresholds, which would mean that B would be the appropriate answer. Let's cover warrants quickly here. What is a warrant? Well, pretty simple. I always imagine if I went to a bank and I had bad credit or no credit at all, they probably wouldn't want to lend me money. Would you agree with that statement? So let's assume that as an investor, I would like to buy some debt securities, and which means I'm going to loan money to an issuer, right? And let's say that this company has no credit. They're new. Or let's say that they've had credit in the past that they haven't handled very well. They have bad credit. I'm unlikely to want to spend my investment income on them. Would you agree? Here I am, like I have, let's say $500,000 to retire and I want to invest it. Would I want to invest it with a company that's not doing well or has never shown themselves as doing well? So what a company might do is they might sweeten the deal by adding a warrant to every bond. Now, Warrants are known as sweeteners. Sometimes we call them bonuses as well. What they would do is every bond I purchased, they would attach a warrant to it, one warrant for each bond. And what this warrant would do is it would say sometime in the future, typically 5 to 7 years, but it could be indefinitely, it could be forever. If the company's stock rises above a certain number, the warranted price, I would be allowed to buy the stock at the warranted price. So let's say the warrant's at 35 and the stock goes to 50 a share. I could exercise my warrant and buy the shares at 35. That's a good enticement, isn't it? So a warrant is long-term, 5 to 7 years, could be indefinite, allows me to purchase the stock at a reduced price, the warranted price, sweetens the deal for me to loan them the money. You understand the company's saying, lend me money, we're trying to grow. And I'm going, I don't want to loan you money because you're not good, you don't have good credit. And they're saying, well, here, we'll sweeten the deal. Because we're so serious and because we believe we're going to grow, we're going to attach a warrant to every bond you buy. So when you loan us this money, it's going to give you a sweetener or an enticement that later on you'll be able to exercise. Now, of course, I can exercise that when that happens, or I could sell it to somebody else, another investor, or I could let it expire, but again, silly if it has value. When we receive dividends, we receive them one of three ways, either a cash dividend, a stock dividend, or a product dividend. Product dividends are typically non-testable, but just know that the product dividend is treated the same as a cash dividend for tax purposes. If I receive a cash dividend, I'm taxed in the year I got it. It's investment income. So any dividends that I received in 2025, I will have to file on my taxes prior to April 15th of 2026. Regardless of what's done with it, even if they put it into my brokerage account and it bought more shares, it's still a dividend that was given to me in 2025, a cash dividend. Product dividends are treated the same way. Stock dividends are different. Stock dividends are not going to tax me until I sell those shares of stock, which could be years from now. So when a stock dividend occurs, it has to adjust the price. Let's take a look at how that can happen. Here, let's say that ABC declares a 10% stock dividend. That's 10% across the board for every shareholder. So depending on how many shares you own, depends on how many shares you'll get in the dividend. So if I own 1,000 shares and it's a 10% dividend, I'll get 100 more. If I own 100 shares, like we have in this example, a 10% dividend would give me 10 more. Now, because there's no taxation at this time, what we have to do is look at this. If I have 100 shares at 50 a share, that's $5,000, isn't it? Well, they would have to adjust the price of my shares in order to still have that same value in my brokerage account. So very simply, I could just take 5,000 divided by 110, and that would tell me what the adjusted cost basis is for my shares once that dividend had been declared. Okay, so pretty simple. If there's not going to be a tax consequence, then they can't change the amount of money I have in my brokerage account. This goes along with stock splits, the same concept. If I have, in this example, 100 shares at 40 a share, that's $4,000. Regardless to how this split occurs, they can't change that because this is not a taxable event for an investor. So let's take a look at, here's Kaplan throws these numbers out there. Let's just throw them on there real quick, okay? I don't need any of them. They're useless to me. Let me explain why. Okay, let's start out with the ratio. Here it's shown a 2-to-1 split, okay? I know that's a forward split. How do I know that? Because the bigger number comes first. That's a forward split. 2 is splitting into 1 in a forward motion. And because one equally goes into two, that's an even split. But let's say instead it was 5-3. Well, the bigger number's still first. I still know that's a forward split, but 3 doesn't equally go into 5, so I know that's an uneven split. Do you see that? Switch it around. Let's say the ratio was 1-2. That is a reverse split because I see that the bigger number is last. The 2 is splitting into 1 in a reverse motion, just like if it was a 3-5. The only difference is this is even, this is uneven. So forward splits, reverse splits. I can tell just by looking at the ratio what type of split it is. Now, once I've been given that information, I say to myself, okay, a forward split is when the company wants to reduce the value of their shares. Typically, that's because they want to open it up to a broader base of investors. So if you're going to reduce the number of shares that I own, but you have to keep this number the same, then you'd have to increase the number of shares I have. That only makes sense. If it was a reverse split, then they want to increase the value of the share. Typically, that's because the shares are becoming dangerously close to being put into penny stock. If they make my shares worth more, then they would have to lower the number of shares that I have in order to keep this the same. Do you see that? Okay, so in this case, it's a forward split. So let's look at what they said. How many shares will the investor have after the split? Well, 40, 2-1, they're being split in half, goes to 20. Then 100 would have to go to 200. 100 times 40 is 4,000. 200 times 20 is 4,000. You see, you check your work by just simply making sure that the aggregate value stays the same. Now, many times it's even easier. You can just simply take a look at something like this. Customer owns 100 shares of XYZ. It's $60 a share. 100 times 60, that's 6,000. I know that. Now, when I come down to take a look at how many shares do they have and what's the value for each share, I just got to find the two that equal 6,000. So if I look at 60 times 50, that's 3,000. So I know that's not it. How about 60 times 200? No, that's 12,000. I know that's not it. How about 30 times 50? That's only 1,500. I know that's not it. How about 30 times 200? $6,000. It's got to be 2 and 4. So it's like a workaround or a trick to answer a split question. Or you might be confronted with something like this. Your customer owns 100 shares of ABC's common stock. They're currently trading at $150 a share. I bought it at $60 a share. They declare a split. What's the value of my position after the split? Well, I know it's got to be the same before and after. But you see, where they try to get you here is they tell you how much they bought the shares for. We don't care about that. What's it worth right now in my account? 100 times 150, that is 15,000. That has to be the same when they're done. And of course, just for giggles, which of the following is a taxable event for an investor when it occurs? Well, we know splits aren't taxable, and we know stock dividends aren't taxable, so it's got to be the cash dividend. All right, guys. So that's some information on equities. I hope that helps you out. I think it should, get you through this unit pretty well. Obviously, I want you to go ahead and read the LEM, the book as well. If you don't have a hard copy, there is a PDF version available on Kaplan on the dashboard under Prepare. So I encourage you to read through those units, through those sections of the unit, and make sure that, if there's anything that I missed in here that you need in addition for your exam, or I may have given you information that goes over and above what you needed as well. So take a look at the LEM, get yourself some notes taken, go ahead and do any takeaways I may have put in your group, and then go ahead and get those checkpoint exams done so we can move into your next unit. Thanks a lot. Let me know if you have any questions.